with the increase in the repo rate recently, many people may be wondering, should I fix my interest rate from variable to fixed? And also, it's also expected that the interest rate is likely to go up in the future. So considering whether you should fix your interest rate is a good idea. So in this video, I want to discuss what things to consider before you change your interest rate from a variable to a fixed interest rate. Hi guys, my name is Nosi and thank you for watching this video if it's your first time. If you're joining again and watching it for the second time or more, thank you very much for that. Please remember to like and subscribe as well. Before you get a loan, also remember to compare from bank to bank and also to do your research. Loans are different from bank to bank, so it's something that we must think about when we want to get a loan. There are other factors that also determine the interest rate that you will be charged, things like your credit score. So the higher your credit score is, then the lower the interest that the bank is going to charge you. So when you are thinking about which bank to go with and which interest rate, what type of interest rate or percentage that the bank is going to give you, think about those type of things. So the better your credit score is, then the better the interest rate that they'll charge you is. I did a video before where I spoke about credit scores. I'll link that in the description below as well. Before you get a loan, remember to take note of the repayment terms and the interest rate. This makes a huge difference when it comes to budgeting, and it makes a huge difference as well when it comes to planning out your finances. The repo rate is determined by the South African Reserve Bank. So when the repo rate goes up, then that in turn means that the prime interest rate goes up. So the repo rate is the rate that the Reserve Bank lends to the bank. The bank then sets the prime interest rate, which is the minimum interest rate that they'll charge to people. Because remember that the prime interest rate is going to be higher than the repo rate because the bank needs to also make money. So the prime interest rate is the minimum interest rate that you will be charged, but also depending on your credit score, that can, how much you are charged specifically and individually also is determined by that. Depending on your credit score, this also affects the interest rate that you will be charged as an individual. A variable interest rate means that when the repo rate goes up, then the interest rate that you will be charged will also go up, because it's passed down from the Reserve Bank to the banks and then to you. So this makes it a little bit difficult when it comes to things like budgeting, and because the money that you'll pay will fluctuate every time there's a change in the repo rate. So you may want to consider fixing it to a fixed interest rate, which I'll discuss a little bit later. But the nice part about having a variable interest rate is that when the prime rate goes down, then you will pay less. So you'll accrue less interest in totality of the loan. Say, for example, the prime interest rate remains the same during the term of the loan that you have, then you will pay less amount of money during the duration of your loan. However, should it change in between, for example, things like a home loan, because a home loan, it tends to be for 20 years or more, it means that there could be multiple changes in the interest rate during that time, and then also in turn affecting how much you'll pay to the bank in totality. So it's also difficult to budget when it comes to having a variable interest rate. You might want to consider changing it to a fixed interest rate, because the beauty about having a fixed interest rate is that it is for a certain period of time. So it won't be for 20 or 30 years, but it could be for a certain period of time. When that term then ends, what can happen is that you can either renegotiate for a new fixed interest term, or you can go back to a variable interest rate. The nice part about this is that you pay the same amount of money every single month, and it's easy for you to budget going forward. So that gives you some kind of control when it comes to finances, because you know this is how much you're going to pay for a certain period of time. A fixed interest rate is usually a little bit higher than what you would have paid. So it could be between 1.5% to 3% higher than what you would have paid had you gone for a variable interest rate. So it's also something to think about, because the bank also needs to leverage its risk when it says we're going to fix your interest rate for 5 years. So the bank needs to make sure that they leverage their risk, and by leveraging their risk, it means then that they'll charge you slightly a little bit higher than what they would have had you gone variable. The South African Reserve Bank will change the interest rate so that inflation is kept at a certain amount. So when they see that things are going up high, what they'll do is then they will adjust the interest rate to curb inflation. So when that is why the interest rate changes over time, because we don't want to be in a situation where we've got runaway inflation. So to curb that and to control that, the government is going to then change the repo rate, because think about it this way: if inflation goes up and the prices are going higher, right, that means that there is more demand versus supply. So to curb that supply versus demand situation, what will happen is that they will increase the repo rate. So the increase the repo rate, which will then increase the prime rate, which will then mean that people are paying more. Say you've got a variable interest rate, are paying more. So because you're paying more for your interest rate, you have less disposable income. That then in turn means that since people have less disposable income to use for buying different things, what will then mean is that inflation is sort of controlled that way. So there's always like a relationship between the interest rate and inflation. So when inflation is going up and prices are going up, it's like, okay, what do? Let's increase the interest rate so that we can manage inflation, so that we don't find ourselves in a situation where we've got hyperinflation or high inflation and the economy sort of collapses. So this is why the Reserve Bank will then increase the interest rate so that they keep inflation between, if I'm not mistaken, between 3 and 6%. I'm not a personal advisor, so please make sure you do your research and all that stuff. However, I think based on the articles that I've been reading, they do predict that the interest rate is likely to go up in the future. So if I was in a situation where I could fix my interest rate, I would. The reason why I would do that is because I would want to be in a situation where I can budget more. Because with inflation going up and things getting more expensive, our salaries are capped at a certain amount of money. Things are going higher and higher and higher. So in any situation where we can fix how much we pay every month, I think it's a good idea for us to do that, because then we're able to budget more, because I know, okay, this is how much I'm going to pay for the next 5 years. So I'm able to budget and know, can I afford this? So before, for example, you do accept a fixed interest rate, before I would accept a fixed interest rate, what I would do is they'll say, okay, if you want to fix your interest rate, this is what we're going to charge you. So then I'll do the calculation to say, okay, this is my money, this is my disposable income. And then I'll calculate how much I can pay. Can I actually afford to pay 1.5 extra or 3% extra from what I'm currently paying? And then can I afford to pay that for the next 5 years? If the answer is yes, then I'll go ahead and fix it. Because if there's a prediction that the interest rate is going to go high, it's going to increase anyways. So, and also, the nice part about having a fixed interest rate is that you're able to manage how much you pay. With the variable interest rate, you're sort of at the mercy of the changing markets, you're at the mercy of the changing repo rate, which then in turn changes the prime interest rate, which then in turn affects how much you pay. So if you want a little bit more control and to just say, okay, I don't want to worry about this, I know I'm going to pay such and such amount for the next 5 years, I'll squeeze and make sure that I can pay that for the next 5 years. It's a better situation to be in, rather than a variable interest rate where it fluctuates as the market fluctuates. It's great that it fluctuates when the repo rate goes down, but when it goes up, it's a little bit painful and you pay a little bit more.